All right, welcome everyone. So glad that everyone's here. So we're gonna start off with the complete guide how to start investing. Kind of, you have no experience at all, and after this video, you should have a general idea how to invest, what to look for, stuff like that. So I just want to start off to say that I am not a financial advisor. I've been in the market for 5, 6 years. I've done extensive research in college to do this. So not a financial advisor, but I do want to say, all this stuff is my years of hard work on the market. Reading a lot about the market, lots of stuff like that. A couple other things I want to say. If you are clicking on this video, I'm very glad to be here for you guys. Maybe your first experience with the stock market. I remember my first experience back in elementary school, just in economics class. I thought of the idea of me owning a piece of one's share would be, owning a piece of the company, and I always liked that idea. So, yeah, very interesting stuff. I hope we can go over, lots of stuff here in the market. Um, and yeah, so I'm gonna also start off by saying, with the stock market, there's a lot of scams. There's people that are going to be selling you this course, probably advertised on this video. You can learn everything for free. I've never spent a penny, and I think that's a valuable lesson that people need to know. So let's dive into this complete guide. I hope by the end of this video you guys will have a good understanding how to buy a stock, what is a stock, stuff like that. So if you want to get out a pen and paper, if you want to screenshot this video, feel free to. I'll leave everything, kind of some links below. So first of all, we're going to start off about the stock market returns. So in average, the stock market returns about 10% a year. It depends what you are, but just this S&P 500, that's kind of what tracks most of the market. And it's called the Standards and Poor 500. It tracks the largest 500 stocks. That usually goes up 10% a year. So if you think, you know, we're going to disclude the rule of 72 for now, but for general, every 10 years you should double your money. We'll just keep it at that. The rule of 72, if you want to look that up, that's a whole other thing. But we'll just, to keep it simple, every 10 years in the average market. This does not account for inflation. So inflation is about 2.5% a year. So the average return also counts in inflation as well. Does not account. I apologize. So here we can see down here is the S&P 500 since 1950s, and this is from the 1930s. So I also want you to keep in mind that the S&P, some years it goes down, some years it goes up, some years it goes up 80%, some years it goes down 20-30%. So it's also important to note that that there is volatility, and that's another key word that I'm going to be saying a lot. I want you guys to know. Volatile means that something moves up and down quick. So if I'm playing a volatile stock, the stock's going to be bouncing up and down really, really quick. A non-volatile stock, like an index fund, we'll get into the more like that. So, for example, the S&P is very unvolatile, but it can get volatile during market crashes and times of fear. So let's go on to the next slide. Investing versus gambling, and this is probably the biggest lesson if you're going to get anything out of this video, is investing versus gambling. So there's a lot of stocks out there. We can call them penny stocks that are very, very cheap. They say they're going to do this, people say they're going to explode, but at the end of the day, if this company doesn't have any revenue, if it isn't really a good company, doesn't have a lot of cash on hand, you're pretty much gambling. You're hoping that someone's going to pay more for it than you did. When you're investing, you're thinking of this company is going to grow, it's going to produce more items, so demand for this product is going to go up. Hopefully it gets more consumers. That's investing. So if I'm investing into a company like Apple, Apple year over year continues to grow. It makes new products. It's expanding. It keeps up with new products. It's beating competition. That's what I'm looking for in an investment. Gambling would be kind of like a penny stock, or a smaller stock that hasn't have a good track record. And then with that, so logic-based investments, which I mean, that'd kind of be the thing with, logic. For me, Apple's very logical. We use it every day. So when I like to invest, I like to look at things I use every day. Let me pick up something in my room. Here's my PS4 controller right here. Right? I like PS4. I think it's going to keep doing well. Maybe I buy Sony. What do I have else laying around me? Okay, I have an iPhone. I'm recording this on a Mac computer. I have, these are the things that we're looking for investing. What's around us every day? What do we use a lot? So that's what I'm going to say logical. And then humans are emotional. And I'm going to say this, if you are holding a stock long term and you can't deal with the price fluctuations, and you sell, that makes you emotional. When you're investing, you have to take emotions out of it. You have to let your money sit. And if you're not comfortable with that, then investing might not be for you. We can get into bonds and we can talk about that. Also, when we're talking about AMC, GameStop, and AMC, we're thinking of following the crowd, right? People have followed the crowd up all this hype. The stock goes up 10,000% and plummets back down. Sometimes if you're following the crowd on some different type of strategies we'll talk about, but you want to stay out of, if someone DMs you in your Instagram saying buy this company, they want the shares to go up. So usually with if we're talking about cryptocurrency, some very small ones, people will DM you and you buy into that, and then it goes up and they sell. And then how to limit emotions. When you're limiting your emotions, you can limit your emotions in your portfolio by having long-term investments instead of gambling. Stuff like Apple, Amazon, Nike, using index funds. We'll talk about that. And if we have solid companies, even if it's a market crash, we know that those companies are going to go back up. So we should not have any no emotions with that. Next thing we'll talk about is the dot-com bubble. This is a very good tip for beginners. Back in the 90s, there was a dot-com bubble. Anything with any ticker with the .com on it was going up thousands of percent. The dot-com bubble hit. Amazon went from $100 to $10. All of these stocks got completely wiped out. Investors lost all their money and only a few survived. We could think of some bubbles in the market right now, possibly. That's up for you to decide. I'm not going to give my opinion on that. I'm going to try to keep this as unbiased as possible. But if a stock's up 10,000%, in a year, or like a certain industry, maybe it's in a bubble. So that's important. Or go to the next slide here. What is a stock? So we've kind of talked about what long-term investing, stuff like that. I don't know if we need to get down to the basics of what is a stock. So stock represents ownership in a publicly traded company, and when you buy, you're an owner. So publicly traded companies are something that is listed on the NASDAQ exchange. So we think of Amazon, Apple, all of these big players. Now something that is not publicly exchanged would be private, would be Elon Musk's Neuralink. There's some stuff, and they have to IPO. What an IPO is that a stock or a company wants to raise funds, and then it gets placed on the NASDAQ. What happens is a bank usually backs them, someone backs them, and in exchange for giving them a lot of money, they give them shares in hope to those shares increase in value. So that's another tangent, but a stock is bought and sold on exchanges. So supply and demand, we could talk more about that. And then stock price fluctuates on demand. So if people are selling, a stock's going to go down. If people are buying, the stock's going to go up. Simple supply and demand. So if, a news article comes about Amazon's going to do something, people are going to keep buying, that stock price goes up. Bad news, people sell, goes down. Companies issue stock to pretty much raise capital. And then another thing what we'll talk about is just on the basic stock talk, stock versus bond. So a stock is a publicly traded company. You have a little bit of ownership when you buy that company, that stock. A bond is federally backed exchange. So what you do is you give money to the government or a company. Let's say you give them $20,000 and they guarantee, and this is what I'm using, guarantee you maybe 3% every year. When they return that money, you'll get that interest back. Right now, bonds are not very, people don't buy bonds right now. The rates are really, really low. So it's about, 3% for a year. But if the bond rates are lower than, 10%, which is the stock market rate, people aren't going to want to buy bonds. So bonds are kind of, wouldn't say dead, but invalid right now. Back in the 70s when, it was up to, you'd get 10 to 12% a year guaranteed. That was more ideal for buyers. So that's why people aren't buying bonds right now. Could change in years to come. Best investment app. So when we talk about we talked about all this stuff, but we need to know where, how do we buy these? What do we buy these through? There's a couple different apps we can talk about each one. These are my favorite. I've used all of these. We'll start with, so investment apps is where you can put money from your bank account into and you buy stocks on there. So we'll start off with Robinhood. I'm sure everyone knows what Robinhood is. I find Robinhood very simple, easy to use. Not a lot of, for the advanced person that needs to see all these different charts and all the stuff like that. It's very basic. I like Robinhood. Another thing is called fractional shares. So one share of Amazon is about $3,300. Not everyone has $3,300 to buy Amazon, but on Robinhood, you could buy maybe a hundredth. You can buy fractional shares, so you can buy a hundredth of Amazon for $30, and so you can. That's why I like Robinhood. You can get all of your money to work at once. TD Ameritrade is really, really good if you're kind of more advanced trader. If you like to look at trend lines, if you like to look at moving averages, Fibonacci levels, I can go on and on. But there's an app called Thinkorswim that's tied in with TD Ameritrade that I like. M1 Finance is the best, in my opinion, if you're just a long-term investor. What it does is you get a pie and you put all these stocks in and you can change what percent of the pie they take up. So if you want Amazon to be 4%, you do that, but it automatically every week you can set it up. One second, sorry. Every week you can set it up so it takes money out of your bank account and automatically reinvests it. Every week. So you don't even have to think about it. So it's very hassle-free. You just kind of let your M1 account there and it goes. So these are a couple options. You can do more YouTube searches on these. I recommend all of these. I would probably say Robinhood and M1 for beginners and TD Ameritrade for experienced people. M1 Finance more for if you just want to be just a very passive investor, which means not do much. You just want your invest in simple stocks and it grows over time you invest. So that's this. And then if you're international, I just listed these. If some people are from Canada, Europe, these are some ones that I have searched on the internet that seem to have good reviews. So I couldn't recommend these from personal experience, but it seems like the general population likes these. So yes, those Trading 212, Quest Trade, and I actually have done eToro. I think I have an account for Bitcoin. I used to, something like that. So that is this your brokerage account, but within those, you're going to have to pick one out of these four. So we're going to go over these. Each one has different opportunities. So you'll download that app and you're going to fill it out, and it's going to say what type of brokerage account do you want. So individual is pretty much just a brokerage account, but you have to pay taxes at the end of the year. So if you want to have all of your monies, I should probably talk about the IRA first, and then we can go back into the individual to make more sense. So let's start off with the IRA down here. So an IRA is a brokerage, or is a brokerage account within it, and what an IRA is it's tax-free until you're 65. So if you're not interested in pulling any money out of your brokerage, if you already have a good savings account, if you're just want to let it sit for 50 years, this is the best way. With an individual account, every year you're going to have to take some of that money out for taxes, and your account is going to grow less and less. With it IRA, if we can, with compound interest, let's say we have $1,000 in our IRA, it grows 10% the next year. So now we have 1,100, but the next year we're not going to get just $100. We're going to get 10%, so we're going to get 1,110. If we start taking taxes out of that every year, that number is going to be smaller than if we would just let it grow in our IRA. If we had to take taxes. Individual is very nice. So 65 is the age on IRA. Individual is nice. You can take out the money whenever you would like, which I like personally. I don't want to be, you can take it out of IRA, but you have to pay heavy fees. So I like the individual. I'll pay my taxes, but all the money in there is mine. Joint account, if you want to make an account with your dad or someone in your family, joint account. Custodial would be if you were, let's say you're 17, 16 years old, you want to get investing, you're not 18 yet, have mom or dad make you a custodial account. That would be the best way for you to get invested. Let's go on to the next. So we know how to buy stocks now. What brokerages to use, what a stock is. We're gonna talk about some investing strategies. We have 4 here that we'll use, and we'll first start with fundamental analysis. So fundamental analysis is kind of associated with value investing. So when I'm thinking of fundamental analysis, I'm going to be looking at revenue from companies year over year. I'm going to be looking at how much debt they're in, stuff like that. It assumes a level of I can't say the word, irra- irrationality in the market. I apologize. So it uses financial ratios. So we'll talk more about financial ratios, but for example, there's this thing called the PE ratio, which is price per earnings. So, we'll talk more about that, and then generally long-term outlook. That's the most thing. So we look at companies that are growing a lot, like something like Amazon, and we have a general term outlook. So we're just gonna go by these quick. We're not gonna go too much into these. Technical analysis is not more, it's not based on what the company is doing, it's more on the charts. So I'm a technical analysis trader. You can look at my other videos, but for example, when a stock makes this pattern, there's general movement. So for Head and Shoulders is bearish, triple top is bearish, flag is super bullish. So there's different patterns you can use. There's different indicators, trend lines. We focus on charts, stuff like that. That'd be a technical analysis trader. This is what I really want to spend the most time on is dollar cost averaging. So let's say that I am buying just the S&P 500, which is, remember, is the top 500 companies. What we want to do, let's say we bought right here at, I don't know, let's say this price was $80 and it fell down to 40. If we buy every year, so let's say we buy some here, we buy some here, we buy some here, 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 over time, it's going to even out. So if we're looking at this chart, this is from a long time, but if we put all of our money right here at the top, it would have taken us 30 years to almost make that back. But if we kept buying all the way up, all the way down, it averages out your costs. So your return is going to be better. It can be better. So dollar cost averaging, every week add some, every month add some. That's the best thing I can say is a long-term investor. It can be a passive investment strategy. You just add shares every week. It reduces the volatility. So what I mean it kind of reduces it is, let's say I buy all this at $100, it falls to 30. But if I buy some at 50, down at 30, over time the volatility gets reduced. And then another thing, a famous quote from is time in the market beats timing the market. So I'd rather have shares in the market than saying, well, I think it's going to drop. Well, if you think it's going to drop, I'd always say, if buy the stock, do not wait. Timing the market's always going to beat timing the market for the most part. And then there's an investor type, so an active. So an active investor is, hand selecting stocks. They're doing research. I wouldn't say, I would disclude this. It can be long term, but an active investor is, usually, maybe buying, selling, updating their portfolio weekly. They're looking at earnings on companies. They're trying to find the best companies. And, there is a lot of risk with that. With Amazon, there's not a lot of risk. With something smaller that's upcoming company, there's a lot of risk in that. So it's a lot more risk for an active investor if you are, but there can be greater returns. And they attempt to beat the market. 90% of traders don't beat the market. That's important to note. We have a passive trader. A passive trader utilizes indexes, ETFs. We're going to go into that. But pretty much what they do is they buy it, they let it sit until they retire. And they're long-term thinking. All right. We're going to talk about index funds. They're my favorite. So we have a stock, which is just, Apple, Amazon. Then we have an index fund. An index fund tracks the movement of a group of stocks. So, for example, the S&P, or the Standard & Poor, tracks the top 500 stocks in the world, in the United States market. The NASDAQ tracks tech stocks. The Dow is the top 30 biggest company, and IWM tracks small caps. So what they do is, over time, let's say, this is the best thing about an index. Let's say we have 500 stocks. Let's say 498 shares go up in a year, and two companies do bad. It's going to average out that it's going to keep going up. If we have, two stocks, and let's say one goes down 50% in a year, one goes up 30%, we're going to be down. With these index funds, there's so much it tracks. So with an index fund, we have a little bit of Apple in there, we have a little bit of Amazon, we have a little bit of Nike, we have all these companies in there. So it's generally going to go up. If one company goes bankrupt, it's not going to disrupt our general movement. So there's less volatility in them, but the returns are going to be less, possibly. Index funds are awesome. I love them. Long term, they always go up, and it reduces volatility. Another type of stock, what we're going to talk about, is a dividend stock. So a dividend stock, for example, is going to be Coca-Cola. It pays you 3% a year just to own its stock. So let's say I own $100 in Coca-Cola. Every year they're going to give me 3%. So they're going to give me $3 back just for owning their stock, guaranteed. It's a part of their revenue they're giving back to the shareholder. It can here for the investors, it's predictable income, which it is, reduced risk, profit without selling. And for the company, loyalty increase, stock price boost, good use of extra cash. That is all true. ETFs are another thing. So we have the index funds, and then we have ETFs. So let's say that I'm really, really bullish, which means I think something is going to go up. I'm really, really bullish on marijuana. You can buy a marijuana ETF. So they're going to find all the marijuana companies. They're going to take a bit from this one, 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 and they're going to make a basket. So they take a little bit from all these different companies that are in the marijuana industry, and they put them all in a basket. So if I'm really bullish about the marijuana theme, I can buy a basket of those. So that way that I'm not just picking one company, because if that company does bad, I'm going to lose all my money. But if I have a basket of them, they're going to, for average, they're going to average out. If one does bad, one does good, they're going to all go up. You can find ETFs on solar. So if you look, there's different ETFs. And I love ETFs if you're, more bullish on something. There's also actively managed ETFs. So ARK from Kathy Wood, she actively manages her ETF. She buys and sells every day. There's some stuff. I'm not going to get too complicated in this video, just basic stuff. So ETFs are a great use for investing. ETFs and index funds. ETFs and index funds. Then we're just going to talk about there's different sectors. So, there's energy, materials, there's all these different sectors. So let's think of energy stocks, XLM, which is energy, materials, MMAP, just different stock tickers I'm listing off. There's different that fall in here. So there's different stock market sectors that, do better sometimes than others. But yeah, you can pay attention to sectors. And then there's some things I want to talk about with the stock fundamentals. There's two things that I just want to talk about real quick. One is PE ratio, so your price per earnings. So if I add up all my earnings and I multiply it by a number is what the PE ratio is. So let's say I'm making $1 million in earnings and my stock is worth 50 million. That means the PE ratio is 50 million. Stocks usually trade at a 22 PE ratio, so anything less is undervalued, anything above is overvalued. But that is with the overvalued stock. If it's the PE is overvalued, it usually means that there could be different reasons why. One, that it's a really high growth company. People are willing to pay more for a company that's growing and growing and growing than one that's pretty stagnant. So you can look at PE ratios. They can be important. Sometimes they can't be in a market cap. A market cap is I see people thinking that Amazon is the biggest company. Amazon is at $3,300 a share, but Apple's at about 150. You have to look at the market cap. The stock price means nothing of how much the stock is or how much the company is actually worth. So what happens is when a share goes up, let's say Amazon, usually companies will they will split their shares. And what I mean by reverse split, or sorry, not reverse split, but just split is let's say Amazon, $3,300 is kind of hard to buy from a lot of people, and they want all their stock to be user friendly. So they might split it into 10. So what they would do is that their shares, how many shares they have, let's say they have 100 million shares, they'll add 10 times those shares, so they'll have 1 billion shares, but the stock price for one stock goes down a tenth. So now the stock would be at $300. So Apple has done a lot of splits, same with Amazon, but you have to look at the market cap. So market cap, Amazon's is like 2 trillion. Apple is there's like 3 trillion. I don't really know much. I couldn't tell you off the top of my head, but I do know Amazon's one of the higher stock prices, but their market cap is lower than Apple, which is 150. Important to note. Wrap up. Let's talk about. We're gonna go to the. We'll do that last. I want to talk about avoiding FOMO, so fear of missing out. There's these individual stocks that are up hundreds of percents. Do not buy them if they're up that much. if they can go down 100%. So fear of missing out, there's hundreds of stocks out there. Do not get fear of missing out. There's hundreds that you can play every day, whatever. Avoiding scam. There's lots of scams out there. People are gonna say, buy my course for $1,000. I'll teach you how to be a good trader. No one's gonna teach you how to be a good trader. They're all scams. You can't really teach someone to be a good trader. It's all from self-taught. How to learn. There's books out there. There's free content. What I'm recording. Look at my channel. Look at other people's. There's so much content out there. And then compound interest calculator. We're just gonna wrap it up. We'll wrap it up with a quick compound interest calculator. I want you guys to see the value of investing. So let's start these numbers. Let's say that we said 10%. So let's say that we start with $10,000. Or no, let's start with $500. Let's say that we're going to add $500 a month, and we're going to put this in for 40 years. And 10%. This should just be investing in just an index fund. $500 a month, starting with 500. You're gonna have 2.6 million. Let's put in $1,000 a month. Where it's gonna 5 million. So just off of these index funds, if you even starting with nothing, we can still retire with a good amount of money. So yeah, and then if we put, let's say that we beat the market, let's put in 15%. Let's see how much that 5% difference makes. So you can retire just off of buying index funds, dollar cost average, and over time you will gain lots of wealth. So I hope this video was important. I kind of just gave the basics how to. I hope it was kind of quick how to. I do a lot of other videos, other stuff, but this was just, I wanted a complete guide, very quick, a little bit in depth how to do this. So I hope you guys have a good one. I hope you guys enjoyed watching, and yeah, I'm gonna cut it here. Please subscribe if you like the video. Please like, and have a happy investing journey.